Yeah,
So,
yeah, that's what
yeah.
Scotiabank has as well. So, well, speaking of Scotia, like I just mentioned, they had not a great
Yeah.
quarter. I was doing it, and we're texting. I'm like, wow, Scotiabank. Like I'm not done yet, but it just does not look great. And you're like, oh no, it's not good. It's not
Yeah,
just you.
it's they've
Right?
really struggled.
Yeah, so their adjusted net income was down 1.6%, and adjusted just because sometimes if you don't adjust, it's not comparing apples to apples, just to make it as simple as possible, of course. Always double check what the adjustments are whenever you look at earnings of a company because, banks will do, it'll be different adjustments depending on the bank and what they actually had to adjust for. So just make sure you look at these adjustments, and same would apply for any kind of other business using metrics. Make sure you understand what the adjustments are. Sometimes they make a whole lot of sense, and sometimes they're not. I'm not going to accuse them of fudging the numbers, but they're trying to make the numbers look better than they are by removing items that are just part of the business. So just a quick note there.
Yeah, I guess the one biggest thing would be acquisitions. Like you'll probably see a lot of
Yeah.
adjusted numbers from somebody like National because of that Canadian Western
Mm.
acquisition. Now that it's coming into results, so they kind of adjust those out because I mean, if you just had surface value numbers, the earnings would look way higher.
Yeah.
Provisions would look way higher because of that acquisition. So that's a
Same for
yeah
Royal with the HSBC
HSBC.
acquisition.
Yeah.
Yeah. Adjusted earnings per share was down 3.8% year over year. Both metrics were even more down if you start comparing quarter over quarter. And that was, I didn't look at all the banks, but the ones I looked at, that was a kind of a constant, is that it looks pretty terrible quarter over quarter. It looks better year over year. The good news is that international banking, global wealth management, and global banking were all up between 7% and 17%. The problem is really with the Canadian banking segment, which was definitely the biggest drag on profits. Adjusted earnings were down 31% year over year for Canadian banking. They attributed that to significantly higher provisions for credit losses for performing loans. So provisions, PCLs, they're actually the banks will set money aside on what they're trying to forecast in a lot of cases what will happen, and it's a bit alarming for performing loans because these are loans that are doing well, and the bank is essentially saying they're like, you know what, with our forecast, and they do provide the different macroeconomic scenarios that they work off of. So usually they'll have several. They'll have a base case, but they'll also have let's say a more positive one, an optimistic scenario, and then they'll have some pessimistic and very pessimistic scenarios. So they have a base case scenario that they work off of, but they try to forecast that and put money aside for those bad loans. Where when you do see those on non-performing loans, well, of course you're going to set money aside because there's a good chance that you won't be recouping. Well, you probably will not be recouping a big chunk of those loans when they're non-performing. It doesn't mean that you won't recoup some of it, but the likelihood that you will is definitely lower than the performing loan. So it's always a bit worrying when you start to see the banks putting more and more money aside for performing loans, because that's them saying that, look, we're a bit nervous with what we're seeing going forward.
Yeah. Yeah, that's pretty much it. Like the performing haven't had payment difficulty, but they kind of expect they could have payment
Mm-hmm.
difficulty. And that was pretty much the case with all banks except for CIBC, which we'll talk about later. But a lot of them put aside, impaired provisions kind of went down, and a lot of them are performing based, which kind of gives an indication on the bank's overall outlook moving forward, because that is obviously when you would put a large chunk of performing loans aside.
Yeah, exactly. And what I'm showing here for joint TCI viewers as subscribers is that I'm showing the actual allowance for credit losses. So you achieve that number. It's pretty simple. So you look at what they actually have set aside on their balance sheet. So the PCL that we just talked about is the additional money they put aside during this quarter. But what they actually have on the balance sheet is the money that that's basically sitting there for these bad loans. And then you can really have an idea of what amount of money they're putting aside from that by just dividing it by the total amount of gross loans. And then that gives you a ratio. I did it for all the banks. We'll show it for the banks that we're talking about today. But essentially, for those listening, it was very high around the pandemic for obvious reason, then started going down significantly lower, especially when the government of Canada started doing like bazooka stimulus. There was a lot of loans that were, a lot of people that were allowed to not pay their loans for a period of time and so on. So you saw that percentage go way down up to about 0.71% at the bottom in 2022, and then it's been increasing ever since, and now this most recent quarter it's at 0.93%. So it's going higher. I honestly would not be surprised to see those percentages continue to go higher for pretty much all of the Canadian banks. I think it's hard to say whether they're a bit behind or not, but I think it's clear to one thing's clear is that they do realize there's a lot more uncertainty, and that the Canadian economy, the outlook, it'll probably be a bit more negative going forward, at least in the short to medium term.
Yeah, and I think Scotia has, outside of TD, I believe like the highest ACL ratio. But I mean, they've also had a very rough go of it for quite a while now. And like we're getting back to 2021 levels when we were sitting in that was still a relatively large period of economic uncertainty, especially when we're talking lockdowns, things like that.
Yeah.
I mean, it's not as high as like peak kind of COVID
yeah.
uncertainty back in 2020, but it's definitely creeping up there, and pretty much all of them are creeping up for sure. Which, I mean, makes sense. I mean, we have no idea what's going to happen. I mean, Trump just doubled tariffs, I believe, this morning on steel and aluminum, and it's a tricky environment. Like, it's going to be very hard for them to forecast. So they're probably being a bit more conservative here.
Yeah, exactly. Like, it's very tricky. We just don't know what the U.S. will do. Of course, they have their own set of issues there with tariffs. I think it's going into the courts, and then I'm sure the Trump administration will find other ways to still impose them if they want to. Will they kind of soften on Canada down the line? That's not a zero possibility. I mean, there's so many potential scenarios. Maybe the impact on the Canadian economy ends up not being as badly. Maybe it's more isolated in certain types of industries. There's a whole lot of different things that could happen. But one thing's clear, pretty much all the banks are increasing the money that they have on the books for bad loans. I think that's the main takeaway here. They said that the reason they are increasing those performing loans provisions are because the continued uncertainty related to U.S. tariffs and the impact of their Canadian banking business, which has been the focus for Scotiabank, because they had a big Latin America focus until a couple of years ago. They started really shifting back to Canada, which may be good in the long term, but that strategy doesn't look great right now. And I mean, I can tell that they are, just from a personal experience. When we bought our new house, we ended up going with Scotia because they were definitely the most aggressive in terms of the offering, in terms of being like actually a pretty good deal for us compared to what we could have elsewhere. So I'm not surprised to hear that. But then again, when you start focusing so much on the Canadian market and things start going a bit sideways for the economy, this is one of the risks that you're kind of facing. So it'll be interesting how it progresses. I mean, they're not alone. All the big Canadian banks, I mean, most of their business is done in Canada. Yes, some have exposure elsewhere. TD has some exposure, obviously, to the U.S., although that's capped for now because of the anti-money laundering. The results of that from the regulators. The last thing that's been good here is net interest margins were up on a year-over-year and quarter-over-quarter basis. So that's always something you want to see. Net interest margins, pretty simple, is essentially the money you deposit to the bank, the interest that they pay you on versus the interest they get when they loan that money out to someone else. So it's just the spread in between. And then you look at what the net interest margin is for across their loans. So that's essentially what you get from from Scotiabank. Overall, I mean, obviously not a great quarter. We'll have to see how it progresses, but I don't own any of the big banks. I would definitely approach them with caution right now, although Let's be honest. If anything really bad would happen, the government would step in. So that's I know I may sound a little bit jaded, but I think that's just a reality. Is they're either uh, globally important, TD Royal Bank, and or they're domestically important. So they would not be. They're too big to fail. That's just the reality.